Hello and welcome to Portfolio Matters Weekly Update Week 26, and I am back from holiday and ready to mumble my way through another update. Thank you, Son of Somerset. I read that comment and I will try to enunciate more clearly. Anyway, before we get into it, Richard will read the disclaimer.
Thank you, Keith. I have to say, I've never thought you mumbled, but I guess every view is valid. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what have we got this week?
Well, we have a packed show for you tonight. Okay, so first of all, going through the weekly events. The Bank of England met and they kept rates unchanged, and they kept their QE program unchanged at £3.4 billion a week. In economic data, we had a load of PMIs. So US PMIs came out unchanged from May at 62.1, which is still very good, but slightly below consensus expectations. UK PMIs were 63.9, which is down from May and down from expectations, but still strong, as we will see when we look at the chart. EU PMIs are looking good, 63.4, up from May and above expectations. And actually, the strongest they've been in quite a while, as we will see. China, however, the economic growth there is fading. So the PMIs for June came in at 51.3, so substantially weaker than elsewhere in the world, and below May and below expectations. And the commentary on Reuters was that the slowdown was due to a shortage of semiconductors, inadequate coal supply, causing a power crunch, and maintenance of equipment. Now, the non-manufacturing PMIs were stronger at 53.5, but again, down from May and below consensus. In the US, the 4-week average new jobless claims were slightly better than expectation. And as we will see in the chart, that is trending steadily down. So it looks like the US is just steadily recovering. EU consumer confidence rose to a massive minus 3.3, which is better than in May when it was minus 5.1. But it was met expectations. And the Michigan US Consumer Sentiment Index hit 85.5. Now, I believe 100 is feeling okay. So, you know, they ain't feeling okay, but it's better than it was in May. Mm-hmm. Quarterly numbers. So we had US GDP growth for Q2, which came in at 6.4%, very strong. But that met expectations. Of course, this is all difficult because of the
base effect.
Base effects. Okay, so let's look at some charts. So this is US manufacturing PMIs over the last 5 years, and you'll see actually they're looking very good, much stronger than pre-COVID. UK the same, coming off a bit, but still really good. EU PMIs are very good and still growing. So the EU confidence is returning to companies. China, however, it's fading. Not great. This is US new jobless claims, and they are steadily declining. So, you know, I think you're just getting a steady recovery there. EU unemployment rate, again, coming down. UK unemployment coming down. Now, I thought this was quite amusing, actually. So this is EU consumer confidence, and presumably 0 is the feeling, averagely okay about the world. And in the last 5 years, the EU consumers have never felt averagely okay about the world. They've always been slightly depressed. And they're now got to minus 3.3, which actually is the best reading they've had since 2018. Better than pre-COVID. So in the US, actually, consumers are not feeling, there's a way to go. 100 is presumably, feeling okay. And they're still a long way down from pre-COVID. So, the US economy has a way to go to fully recover. Okay, so moving on to other charts that caught our interest over the course of the week. Now, regular viewers will know we have been talking about the surprising quiescence of the Treasury bond market and how yields have actually fallen back. Whereas we have been worried about inflation, bonds have not been worried about inflation. And one of the reasons that yields have fallen back may be the fact that the US has not been selling any bonds recently. So they haven't really been testing the capacity of the bond markets to buy vast numbers of new Treasury bills as they continue to run a big fiscal deficit. Essentially, the Trump administration sold loads of bonds in advance and pumped up the Treasury general account. Now, the current Biden administration is running down the Treasury general account, and soon it will have to start selling bonds again. But in Q2, the Fed essentially bought more treasuries than were issued by the US. So unsurprisingly, treasury yields fell, but that will not be the case going forwards. So watch this space. Okay, so moving on to US GDP. Now, I thought this was interesting in that Goldman are forecasting that US GDP growth will decline from Q3. So we'll peak in Q3, and then next year it will really fall quite substantially. And on that note, this is a chart of various surveys of US business conditions, and you'll see they peaked in April. So have we already seen the peak of US GDP growth? Now, frankly, I think it's far too early to say that. I think we're at the early stages of a normal recovery. And as confidence returns, then I think GDP growth will pick up. But, Richard.
So, Keith, this is the US Small Businesses Open chart that we regularly show, and it has taken an alarming dive back down to the levels of the depths of the COVID trough. And small businesses in the US are still hurting significantly. And the next graph is the small businesses revenue, which, not surprisingly, is basically following that down. So my view is that this data should be really alarming to the US monetary and fiscal authorities, because it indicates that the economy is really, really severely damaged underneath. And to me, that suggests that Goldman Sachs are right, that US GDP growth will start to decline, that we have the unemployment rate is falling, but the labour participation rate is also falling. It is a hugely indebted country, and there's a recent analysis shows that for every pound of debt taken on by the US economy, it's creating about 65 cents of GDP. And the commodity prices are continuing to stabilize or increase. And apart from lumber, which clearly hit some sort of huge speculative excess, there is no sign of commodity price inflation declining, or at least the commodity price is dropping back down. So my concern actually is that we are heading into a stagflation. I'm not sure that the US labour market is prepared to start taking pay cuts, having had pay rises. And if we do move into either a drop in GDP and or an inflationary environment, the Fed is going to be totally stuck because it will want to reinitiate large quantities of QE to boost the economy. But clearly, if we have an inflationary environment, that's a difficult thing to do. My concern is that we are heading towards stagflation.
Well, I'd say a couple of things, Richard. First of all, I think it's difficult to see sustained inflation if you have sustained unemployment. And we are seeing unemployment come back down, but it remains at elevated levels. So I don't think actually there's much danger of sustained inflation now.
You may well be right, Keith, but the difficulty is that it is also a psychology of the workforce. And if the psychology of the workforce is we aren't earning enough, we have hidden inflation, the authorities are lying to us because inflation is clearly greater than they're saying, which fundamentally I think it probably is, then it comes back down to what the labour force will actually accept. And I'm not sure that there isn't a change in psychology going on as a consequence of the pandemic social security measures and so forth.
Well, one of the things that is puzzling about the current situation is that US businesses are all reporting labour shortages, but unemployment remains high and labour force participation rates remain relatively low. So what on earth is going on? The other thing I'd say about these charts are they show that actually the US economy has been badly damaged by COVID, and that a lot of small businesses are going out of business when all the furlough and support schemes are removed, in which case, to me, it just says that recovery will take longer than expected.
Yes, and there's no particular reason to assume that the UK and the EU should be any different.
Yeah, I agree. So this chart shows the white line is workers' confidence that there are lots of jobs. And so they're saying, workers are saying jobs are plentiful. And the blue line is workers saying it's difficult to find a job. So they're both essentially saying the same thing. Workers are very confident that there are lots of jobs available and they're easy to get. In previous weeklies, one of the theories that we have propounded about why there's a shortage of workers currently in the US is that high COVID unemployment relief payments have basically meant that low-paid workers are better off staying at home and don't want to go back to work. But this chart shows on the x-axis unemployment benefits as a percentage of low wages. So the x-axis shows unemployment benefits as a percentage of the minimum wage. And you'll notice none of them go above 100, which is a puzzle, because we know from other data we have featured that in some states it definitely did go above 100. And on the y-axis, we have non-farm payrolls growth between January and May. And what this chart shows is there's no relationship. So high unemployment benefits have not resulted in people staying at home, basically.
So basically, we don't really know what's going on in the labour market, but it's behaving in a way that it's odd and isn't consistent with pre-COVID.
Precisely. We don't know what's going on.
Yeah.
It may be, people are being slow to get back to work for whatever reason.
Yeah.
Now, is the Fed blowing a big bubble in the US housing market? Because interest rates are very low, asset prices are very high, and houses are assets. So house prices have shot up. Here we go. US house price inflation has accelerated, unsurprisingly. When mortgage rates are really low, the economy is opening back up, and lots of workers have savings again. They've rebuilt their personal balance sheets. But high house prices are now deterring buyers. So this is existing home sales, and they've come off their peak. So is the US housing market now self-limiting in that very high house prices are actually putting off buyers, and eventually that will feed through to lower activity?
Yeah, and a reduction in GDP.
Yeah. Now, I thought this was interesting as an aside. In 50 years, London house prices have risen 100-fold.
It's amazing.
Now, in the US wage inflation for load-paid workers now, which is the blue line, now exceeds wage inflation for white-collar workers, which is the white line. And that is the first time that has happened essentially in the last 25 years. So, you know, money is going to the people who actually spend it rather than the people who tend to save it. All of that is inflationary. And when we talk about inflation, this is container shipping rates from China, and that continues to rise. So the price of imports from China will continue to rise. And as Richard talked about stagflation, you know, imports are rising. Richard?
So graph showing the inflation in the Eurozone, manufacturing inflation, so purchasing managers price sub-index, I beg your pardon. So the manufacturing index is up to 70 from where it's mostly been around 50 for the best part of the last decade. Services inflation is lower, and the composite is somewhere in between. But the manufacturing inflation for this data set is significant, and if and when it feeds through into final pricing, it's going to have a significant effect on inflation in the Eurozone.
So I noticed inflation on the Eurozone actually ticked down this month.
I saw that as well. So, you know, this will be coming through presumably in the course of the next couple of months.
Yeah.
And this is a transcripts that mention labour shortage. It's the US survey, one of these linguistic analytic programs. But clearly, labour shortage is a very significant factor at the moment in the US business sector, and it's significantly greater than it has been over the last 18 years. So there is something going on here in terms of labour shortage. There is no shortage of labour, it's just that people don't want the jobs.
Interesting.
And the question is, what will entice them back into the labour force? COMEX US Midwest hot rolled coiled steel, January 600, July 1800.
Wow.
That's a threefold increase. Extraordinary.
Yeah, absolutely. And that is the price of raw ingredients going into manufactured goods.
Yeah.
Yeah.
And it's still going up.
Yeah. Now, previously, when we were going through the economic data this week, we talked about how Chinese GDP growth seems to be slowing. And here you're seeing actually Chinese credit growth is back down to zero, essentially, and it's falling. And this is not a happy looking chart. So anything that relies on China, such as all the commodity indices, may be weak going forward if they're relying on Chinese demand, because Chinese demand seems to be slowing and is something we all need to be aware of, actually.
And the suggestion is that global PMIs will follow that thick line down.
Yeah. Personally, I'm skeptical, actually, because the rest of the world, as we open up, the economy should naturally rebalance. Everyone's got money in their pockets. Yeah. It's just a question of allowing them to spend it, basically.
Yeah.
And on that note, in the US, this is a chart of disposable income, both real and nominal. And you'll see consumers have savings. And it's really just a question of, are they allowed to spend it? Are they allowed to go on holiday, etc.? And I think as restrictions come off and people get back to work, then we will have a self-sustaining recovery. Now, I thought this was really interesting. US corporate earnings have fully recovered from pre-COVID levels and are actually higher than they were in Q4 19 and are forecast to keep on rising strongly.
That's interesting.
So given the state of the economy, I think what's happening is that large companies have survived and are thriving, and small companies seem to have suffered. Yeah. This is the chart showing the performance of US equities versus the rest of the world since the great financial crisis. And so you'll see that prior to the great financial crisis, everything starts at 100. In, what's that, 13 years, rest of the world has gone precisely nowhere, whereas the US equities have gone up 275%. So you really need to be invested in the US to have done well over the last 13 years. And an explanation for that outperformance is that US companies have grown their earnings over that period, whereas the earnings of the rest of the world have actually declined.
Yeah. As you put it, the US companies have been eating the rest of the world's lunch. US
absolutely.
Companies.
Yeah. So if you think of like advertising agencies, etc., all that's disappeared to the US.
Yeah.
And quickly talk about COVID. COVID infections in the UK are rising, which is bad, but the death rate really hasn't picked up much at all.
And it's had long enough to start to pick up now with the rising infection rate. The problem will come for countries that don't have the high vaccination levels that we have.
Yeah.
If the Delta variant gets a hold in them.
Yeah, but in the UK, hopefully, we are seeing an end of this. And when we are on course to open up again next month, is fingers crossed.
Yes, this month now, Keith.
Yeah, true. Richard, do you want to go through these?
Thanks, Keith. So the FTSE All Share unchanged, S&P 500 and NASDAQ each up over 2%, doing extraordinarily well.
Yeah.
Topics slightly down, Bitcoin down 11%, and GBP USD slightly down. The equity inflows have, this is from January 19, so over the last 3 years, equity inflows have started to go above zero in the last couple of months. But it's interesting to see that the level of bond inflows has continued at a very high rate, despite the fact that the return on bonds is very low or negative. One exclamation may be forced buying by pension funds and insurance companies.
I find this chart's absolutely amazing, actually, because the thing is, if you read the FT, etc., and you think, you read the financial news and it's full of GameStop and everyone playing around the markets, you might get the impression that everyone has been piling into equities. Certainly, I had that impression.
Yeah.
And then you look at it, and actually, that's not the case. People have been incredibly cautious. And
I was saying, if you look at the margin graphs, and you would think that people were piling in, but clearly that must be, no pun intended, on the margin.
And on that note, Richard, I mean, these two charts are connected because the fear and greed index actually is mainly fear. And part of that is demand for safe havens like bonds and cash, is very high. People are paying up essentially for bonds.
A lot of people are asking the question, has the market peaked? Is it going to crash? What's holding it up?
Well, I'm very skeptical of all these bearish arguments because I think we're at the start of a self-sustaining economic recovery. And as the economy opens up and people are allowed to go and spend their money, I think they will do. I think the natural healing processes of the economy will start to work. And however, this I thought was really interesting. So given the fact that the Chinese credit impulse is slowing, the Chinese are messing around in the stock market once again. And you will see that the last time they did this was back in 2015, when margin debt absolutely exploded. And if we look at what happened in 2015, it didn't end well.
No.
Richard.
Bitcoin. So Bitcoin is showing a sort of very odd type of head and shoulders pattern here with a lot of peaks on the head. If you just flick through to the Ethereum chart, Keith, Ethereum is a much clearer head and shoulders. Now, the point about head and shoulders patterns is that, as I think I mentioned last week or the week before, they tend to, the price tends to, if it follows the chartist's concept, the price will drop roughly the height of the head above the shoulder, below the shoulder, which will takes Ethereum back down to a negative number, I think. Well, so obviously that's not going to happen. But it takes Ethereum really quite low. And if you remember the log chart, which we showed last week, if it were to hit the straight line on the log chart, then it would drop to around about 500. And just go back to Bitcoin, Keith. The same is true for Bitcoin. If the head and shoulders pattern resolves itself, as they sometimes do, you would see the price of Bitcoin dropping dramatically. Now, I'm actually not saying that it's going to, but I am saying it's a very dodgy time to be invested or to be trading these assets, because there is, I think, a significant chance that there's quite a lot further for them to fall. There's also a chance that they don't fall and that they go back up from here. And I guess my view is, if you want to be in these markets, you have to have a toe in the water and not much else.
Right. Well, I think we're in agreement on this one, Richard, in that from my non-technical point of view, I think there's a long way to fall.
I believe in the decentralized finance and the blockchain software will start to displace intermediaries and so forth, and that over the long term these changes will happen, but they're not happening this quickly, and they're not coming into the real economy this quickly. So there is likely to be a great deal of volatility about.
Well, just from a fundamental perspective, Bitcoin, I mean, it's not really very useful for very much unless you want to buy dodgy stuff on the dark web. And everyone mainly holds it because number go up. As long as the price goes up, they're buying it because they're expecting to make money. And once that ceases to happen and the price starts to going down, then why do you hold it?
Yeah, agreed. And the altcoin chart, for the sake of Keith blushes, I won't call it what it's actually known as. The has halved as well, and it's sort of showing a similar sort of pattern to Bitcoin and Ethereum.
Okay, moving on to the industrials checklist, and again, just an absolutely astonishing week generally. Aluminium up 3.9%, cobalt bounced, and it bounced hard, up 10%. Copper is kind of flattish on the week, down 0.5%. Chromium up 1%. Iron ore came off a touch from its massive highs, down 2.5%. Lithium and neodymium were flat. Nickel bounced up 6.7%. These are big numbers. Ferrovanadium up 1.2%. Crude oil up the best part of 6% on the week. OPEC Plus meeting is going on right now, and markets are up about 2% today. On speculation, that's going to be all right. Coal, amazing, 7.4% up on the week. Uranium flat. And so we go through a few of these charts. Now, first of all, this is a warning to all commodity speculators. So this is the chart of US lumber futures. And we go back to April last year, they were trading at around, well, that's that 250. And then they peaked at 1600. What's that? Sixfold?
Yeah.
But since then, in 6 short weeks, they have halved. So, you know.
And some of those moves would have been limit down. So the people who were in at the top won't have been able to get out for quite some way down, which would have been really uncomfortable.
Yeah, very good point, Richard. Okay, so talking quickly about oil. In the US, we are seeing sustained drawdowns in inventories every week. So this is last week, and the HFI research were forecasting a drawdown of 9 million barrels last week alone. And I have read forecasts that once the summer driving season gets underway, you will see 100 million barrels taken out of inventories in August alone. And that would all be very bullish for oil. And all that is happening when the US drivers have not really got back behind the wheel to a normal extent. So you'll see the current extent of gasoline consumption in the US is about at the bottom of the trough of a normal cycle. There's a long way to go for the US economy to get back to normal. Now, moving on to some of the commodity price charts, aluminium looks great. Cobalt, you know, that sell-off is recovering incredibly quickly from the sell-off. Copper, it's bounced, but who knows? Crude oil, I mean, that looks like a straight line up. And today, crude oil is up over 2%. The OPEC Plus meeting, the reports I have read suggest that they're going to agree to increase production by about 2 million barrels by the end of the year by increasing daily production by 400,000 barrels a day each month between August and December. And the market likes that. The market thinks that won't be enough. And it's having a good day. Coal.
Yeah, just on oil, Keith, I think the US shale is continuing to not increase its production levels, isn't it?
It is. Yeah. And frankly, that's suiting everyone. As long as they can maintain discipline, you know, they're not spending money and their profits are going through the roof. So let's see if their discipline holds. At some stage, it will break.
Yes.
Coal, amazing.
I did read that there's been flooding in Western Australia, which has affected coal mining there, production.
Yeah. Now, of course, if we want to do the energy transition, we need coal to be really expensive to substitute in, you know, cheaper renewables and gas. So, you know, for the planet, this is a good chart.
So interestingly, if you, I think if you put, is it 1 kilogram of vanadium into a ton of steel, you double the strength. Alternatively, you halve the amount of steel you have to use.
Yeah.
And it's 750 kilograms of coal to a ton of steel. So if you use a little bit of vanadium, you can reduce the amount of coal you need to by a half.
Yeah.
So the question you have to ask is why isn't all steel vanadium steel? And what does that do to the vanadium market if it is?
Well, absolutely. Yeah. No, I completely agree, and that is something that Bushveld Minerals and Ferroalloy Resources say in their presentations, that you could massively reduce carbon emissions if you mandated more vanadium in steel.
And with the price of coal going up like this, there's a clear economic incentive to do that, one would have thought.
Yes. So Ferroalloy need to get their project done as soon as possible. Iron ore refuses to come down. Nickel, it's bounced off its lows. A lot of these is you have the speculative peak, bounces down, but actually there's strong demand. The price recovers. And this is ferrovanadium we've just been talking about. It's had a little down dip this week, but still that looks a very strong chart. Moving on to precious metals. Richard, do you want to do this?
Thanks, Keith. So gold had another slightly down week, as did silver. They're trading below, gold trading below 1800. Platinum up a little bit, and rhodium significant down week again, but palladium up. So these platinum, rhodium, palladium, they are bouncing around quite significantly, and they're all mined as a group. So this must be actually making life quite difficult for the miners, because they'll be juggling their production costs and their mixes and so forth to try and keep up with what's going on in the pricing of these metals.
Now, one thing that in previous weeklies we have featured charts which purport to show a very strong link between bond yields, low bond yields, and rising gold prices. And Richard has always treated these charts with some skepticism. And frankly, this week's performance rather proves Richard right, because bond yields have been falling and gold price has been falling, which it shouldn't have been doing. It should have been going up. Now, the way I attribute this is I see gold as a safe haven, and right now it looks like the risks of inflation have gone away and the need for a safe haven is rather diminished.
Yeah, you could be right, Keith.
So this is the gold price, and as interest rates have fallen over the last month, gold has actually fallen through the floor. So all those charts will suddenly disappear from your inbox. This is silver, which has followed gold. Richard?
So it's an interesting graph showing the median free cash flow yield on gold and silver miners, which has basically been negative and substantially negative for 30 odd years. And in the last few years, couple of years, it has become positive. And I think this is a chart that shows that with the current pricing and discipline of management of gold and silver miners in general, these businesses are beginning to throw off cash, which means that they are a much more viable investment. It makes them less speculative, more viable as a long-term buy and hold and dividend yield investment. And as long as the price of gold and silver remain around these levels, then you would expect them to continue to start generating reasonable quantities of cash.
Yes, absolutely. Platinum down from its recent highs, but recovering. Rhodium had a really bad week. Now, is that the end of this drawdown? We don't know. But still, when you look at the price this time a year ago, it is still 3 times that. So,
yes.
And palladium, big drop and then an almost instant recovery.
Yeah, that's what makes you wonder why it dropped so suddenly in the first place, because it's such a big change, out and back for a commodity. Difficult to understand what's going on there.
Well, the thing is, if speculative positions get too large and it sells off, then the sell-off becomes self-reinforcing.
Yeah.
Because you get, margin calls, etc. People are forced liquidating. And, that is the danger with all these commodities, such as lumber. If it goes up too high and speculators come in, then you can get these big sell-offs. Okay, moving on to rates. So very little change this week. Basically, falls at the short end and rise in yields at the long end. So actually what that is saying is that the market thinks that probably economic growth is weakening over the next 5 to 10 years, but is more concerned about inflation long term. This is the UK 30-year gilt, and you'll see its expectations for inflation have essentially peaked for the short term. And the same is true in the US. And finally, our favorite chart, which this week is saying we've done okay. And that certainly is the true in the US, but not in the UK.
No.
So, and it's saying July is rather indifferent, August is poor, September's disastrous.
And then the run up to Christmas is great.
Yeah, exactly. So, if you want to go on holiday, then this might be the time to do it. Although I would say yet again that this is an extraordinary year. So, I'd discard this. Anyway, right, moving on. Richard, do you want to go through your activity?
Thank you, Keith. So my weekly update. So week 24 is down 1.3%, week 25 down 1.6%, week 26 down 0.8%. So fairly mediocre performance, I would say, for the first half of the year. Somewhat disappointing month. And hopefully the second half of the year will perk up a bit. I only made one purchase this week, which was Rambler Metals and Mining. And I made that because I thought their announcement gave a great deal of stability to their position and allowed them to move forward with the funding in place. And there was a little allusion to the resource, firming up on the resource for a couple of their projects, which suggests that they want to identify exactly where their value lies. So I just like the feel of it, and I think it's gone through quite a difficult time, and I thought it was perhaps a good opportunity to buy in. Time will tell. Keith.
Thank you, Richard. Well, like Richard, I had a rather indifferent week. I was down 0.2%, which takes me up to plus 6.7% on the year, so still underperforming Richard. Although I noticed your portfolio is much, much more volatile than mine. And I'm heavily underperforming the all share, which is rather disappointing. Now, I did no selling, and when I was on holiday, I had a number of limit orders hit. So I bought more Rambler Metals and Mining. I bought more Valaris, which is a dodgy, high-risk oil services company. I bought more RS Strategic, and my limit order got hit at the all-time low, or the recent low. So that was
well
great.
done, Keith.
And it's since recovered somewhat. So it's nice when that happens. And I have on my SIP, I've got a policy now of any dividends I receive, I'm sticking into diversified energy, which has a yield of 11%. What's not to love? So I had my dividends from BP, Shell, and others. And I bought some diversified energy.
Well done.
Now, we had a load of updates on companies that we're interested in this week. Now, Ferro Alloy Resources, the Vision Blue investment has gone through and there is progress there. So they are working on doing the bankable feasibility study for the I won't try and pronounce it actually.
In Kazakhstan.
The one in Kazakhstan that's unpronounceable, that one. So next year, things start to move, hopefully. Now, this is the sad tale of the underperformance of my portfolio in one chart. And the orange line is Brent, which I have correctly forecast would rise strongly this year. And the blue line are UK oil equities, which is a huge chunk of my portfolio and which have gone precisely nowhere. So that gap represents a great deal of profitability for the oil companies, which is not being reflected in their share price. And at some stage, I expect the market to wake up, but we are still waiting. And in the meantime, other companies we have covered. Excelsior Mining had an update this week. The CEO appeared on a webinar in which he discussed the problems. And frankly, we discussed this on a Discord channel, but there are problems and they're ongoing. So the big problem is the calcite. And the bottom line is that he's now saying that their solution for dealing with the calcite will be flushing the wells with water for an entire year before all the calcite is removed. And that means production delays. And also, frankly, they don't have enough water. They've only got enough water for about 4 wells.
Also struck me, Keith, that this problem is, the calcite exists throughout the deposit, presumably. So every time they drill a hole, they're going to have exactly the same problem. And I can't see, I don't know what the feasibility is of just digging this stuff out in an open pit, whether in fact that is going to ultimately be the route they have to take.
I have a great deal of confidence in human ingenuity, Rich, and I think eventually they'll get a way around this. But currently, the solution seems to be every time you drill a new well, you have to flush it with acid and water for a whole year before you bring it into production. That means delays, capital, slowly bringing things into production. Not good.
No.
Now, Rambler, we did a whole share talk on their recent update, and I won't go into this in depth, but we had a very good exchange on our Discord channel with Cornish Knocker, who is the acknowledged expert amongst private investors about Rambler Metals and Mining, and he put me right on a couple of things I said during the update. Now, number one, the most important one, is I slightly beat myself up about the fact I missed the fact that Rambler once again undershot their production forecasts. And he is saying that the only reason they underperformed their earlier forecasts is because of the stope collapse. And when the stope collapsed, a great deal of waste rock was deposited into the mine, and obviously that then dilutes the ore there. So that's the reason they're not mining that particular stope, is that they'd have to process all the waste rock with the ore. And so essentially that's not economically feasible. Now, if that's true, then, frankly, the reason they've missed their production forecasts is just bad luck, and everything should get back on schedule. And also, once they get the ore sorter, they will actually be able to sort that out. They'll be able to get rid of the waste rock and actually recover that ore. That's one thing. The other thing is, I interpreted the word commissioning as being getting the ore sorter into commission, i.e. starting construction. Actually, and I've looked this up and Cornish Knocker has pointed this out to me, commissioning means bringing it into operation. So that means the ore sorter should be in operation in H2 2022. So that is good news.
Good.
But there's a great deal of detailed discussion from very informed private investors on our Discord channel. If you are interested, please join. Now, one thing that has been puzzling me is that various shares of mine have had share consolidations. So they've consolidated, their share price has been completely bombed out because of terrible underperformance during COVID and, issuing lots of new shares. And then this year, as they've got their finances sorted out and things have looked up, they've realized that having a share price of, 3.5p looks bad, and they've decided to do a 20-for-1 share consolidation. Now, various private investors have said to me that share consolidations are generally bad for the share price. And I was rather naively sticking to my efficient markets hypothesis, thinking, well, that can't be true. But actually, it does seem to work that way. So this is Trinity Exploration and Production, and the green line is when they had their share consolidation. Share price has promptly fallen, what's that, 10%? Mm-hmm. Rambler Metals and Mining, share consolidation, share price has promptly fallen by a third. Harbour Energy, and this is like the most mystifying one because it's the biggest. You know, share consolidation, share price promptly falls by 10%. You know, the only rational explanation I can have for this is that on my stockbroking account, when, for example, Harbour Energy had their 20-for-1 share consolidation, it was showing on my account that the share price having risen 2,000%. So my shares had not reflected the consolidation, but the share price had. And so if you looked at the value of my account, it had gone through the roof. Now, obviously, I wasn't stupid enough to try and sell, you know, this vast amount of Harbour Energy. But I wonder if people have limit orders that they have set and left, and those get filled, and there's a lot of selling. But anyway, you'd expect that to pass quite quickly. So it's a puzzle. And that's me done. So I think we are done for the week. Okay. Thank you all for watching. I hope you will press like and subscribe to the channel. And in the meantime, it is goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.